Okay, welcome to another weekly market analysis. My name is Gavin Pannu. This is your Alphachain webinar, live webinar as well. It is the 27th of June, and we're heading towards the end of the month. We have 4 weeks of trading left. So the 27th, 28th, 29th, 30th ends on Thursday. And what a month it's been so far. Yeah, there's a lot of volatility in the markets. Markets, have gone into bear markets, now back out of the bear markets territory, and sort of, some buoyant sentiment taking place from market participants. More on that a little bit later, but at the current moment, I think the focus is largely going to be around the equity markets. We'll explore what's been taking place from last week's session, which is so different from the previous week's sessions that we've seen. And is this truly the bottom? Have we formed the bottom, and are we seeing now a recovery in play? Or is there potentially a bull market trap, or this is a potentially sell the highs opportunity? So we'll explore more on that a little bit later. So let's get straight into it. Now, looking at the charts, we're going to begin with, ideally, equity markets. Okay, so that's where the focus should be, equity markets. Now, Asian stocks made some headway overnight. We've seen them, already making a strong start to this final week of June. The Nikkei was up, I believe, around 1%. The Australian index rose around 1.7%. The Chinese markets also made some gains. That includes the Hang Seng as well, which touched its highest level in almost 3 months. Now, why is that the case? Why is Asian markets so far overnight come up quite positive? Well, sentiment was due to positive news from Shanghai, where authorities have declared victory over the recent COVID outbreak. So we're potentially seeing these restrictions and regional restrictions that have occurred in a number of 3-4 months now in China, and China maintaining a zero COVID policy, and has come to some conclusion potentially with them declaring that they've got a victory over these COVID cases now. So COVID cases being at their super low at this moment. That's in China specifically. Right, so that sort of, tells us why we've seen Asian markets a little bit more buoyant and bullish at this current moment. And that follows through from the close of last week's session. So we saw last week, Thursday and Friday, leading to a very positive outcome. Now, Friday's surge in particular, just looking at, say, the S&P 500, this is the Friday's candle. What a candle it was, right? So it's broke through out of the through the Fibonacci resistance level that we have in place. This is also around the 20% technical correction level, right? So this is where we see the bear market territory below this level in this region here, and it's crossed back above into sort of the correction phase. So out of the bear market into the correction phase. And what we're looking to sort of assess is they're going to be a follow through. But okay, let's explore it a bit more. So Friday surge in the US market, but also in the European markets, seems to have been driven by a combination of whether it's bargain hunting. So we're seeing, as we're leading to the end of the month, we're seeing individuals starting to accumulate, buy some of the assets that they would originally have bought at a higher price going back a few months ago, right? So they're starting to buy in at these bargain levels where certain corporations and companies that they have been interested in and were part of their watch list are now 50% lower, 80% off, whatever it might be, depending on what you're looking at. But we've seen a discount potentially in across the board, across all asset classes and assets within those asset classes. And just to sort of reflect that and give you an indication, if that's a true case or not. If we're now potentially seeing that price to earning ratios of most of these corporations coming back in line to around the 2008 to 2010 price regions, okay, those price to earning regions. So we're seeing certainly a substantial discount from where we had seen prices at all-time highs. So, is there buyer hunting taking place? Let me know. Do let me know. Let me know in the chat. Are you purchasing any assets at this moment, or are you still waiting on the sidelines, waiting for price action to confirm or move further to the downside before you actually look to accumulate part of your portfolio? Now, moving on, let me just bring up the chat as well so I can see the chat. Yeah, so that sort of gives you some realistic perspective there, that we're seeing price to earning levels back to those 2008, 2010 regions. So certainly a substantial correction in that space. Now, okay, so we've seen buying hunting taking place potentially, but then at the same time, there are some hopes that the pace of the US hikes might slow to an extent, right? So that might slow down to an extent. Now, that did not substantially come across in Powell's testimony in Congress, and there's a two-day event that had taken place last week. I believe it's Tuesday, Wednesday. So we did see a case of Powell testifying in front of the senators. But again, you know, I'll touch on that a little bit more later. But those are sort of the two elements that I'd seen in regards to from a market sentiment that led to it being at the start of the week quite bearish, and then pivoting, turning around, and then becoming more bullish, right, towards the end of last week. And that's either bargain hunting, or we're seeing markets seeming that they don't believe that the central banks can continue with the rate hikes that we're seeing, and that might slow down. Okay, and naturally, if you slow down the rate hikes, then we're going to see a bit more of a risk-on mood taking place, and that's what we've seen in the last few sessions. However, while there could be yet to be confirmed some further upside that we're seeing in stocks, the broader outlook for high inflation and rising rates seems to point towards a continuation of a slowdown in both economic growth and economic earnings. So we're not looking backwards. What's already happened in regards to, okay, we're seeing corporations sold off, their share prices have sold off substantially, somewhere between 40 to 80%, depending on what asset you're looking at. Those price to earning ratios have come back in line to sort of a median range that it was achieved in 2008 and 2010. And we're potentially seeing that the Fed may begin to review the incoming data before it makes a decision, rather than going all full-on hawkish aggressive with consistent rate hikes. But if you look going forward, what are some of the issues that are still around that the markets haven't anticipated, right? And clearly high inflation, right? So inflation is not going to be reduced anytime soon. Okay, so that's the broader outlook risk that we have, is that high inflation stays where it is, or it continues to trend higher. Markets did forecast the last US CPI print to come in line, and it didn't come in line. It came out higher than previously. So the fact is, inflation is here to stay higher, stay at these high elevated levels for some time. And the question will be is, okay, if it stays between a certain range, the markets can let me just mute everyone. Hang on. Okay, there we go. So market participants will then be able to manage and trade accordingly. But if we see that inflation levels continue to risk to the upside, then that's going to certainly bring equity markets lower. So the inflation scenario hasn't gone away. It's still on the cards. It's still, as we now know, it's not transitory. So it's going to be persistent for some time. And I'll also mention something that Jerome Powell mentioned a little bit later on, but in his testimony. But before we go into that, okay, so we know that inflation is certainly sort of a big concern there, right? But at the same time, the other outlook will be is how is that going to have an impact on economic growth as well as earnings. Okay, economic growth and earnings. Those are my two biggest concerns now. Now, as we end the month of June, what does that mean? That's the end of Q2. Okay, so we're going into Q3 now. Now we're going to receive GDP quarter results now, right? The previous US quarter Q1 GDP came in lower than expected. Okay, so already a negative lower print came in place. Now, if we see another negative print at the end of this week, towards the end of this week, that's certainly going to cry out recession, as that actually, so two negative GDP quarters tends to mean a technical recession, right? So 6 months of negative GDP certainly gives you a technical recession. So we will be technically in a recession, right? And that's the biggest concern, is that if we're technically in a recession and we see GDP fall, meaning growth is falling, but at the same time, inflation stays high, we're in a sort of a stagflation period, slow growth, inflation still rampant or at these elevated levels. And that's going to have a knock-on impact on earning reports. And we're expecting strong amount of earning reports. We've got a few this week. For example, Nike are releasing some of their earnings this week as well. So we have Nike's earnings this week. We've got HP's earnings this week also. But next week, that just starts to ramp up as we go into earnings season. Okay, so, we're going to look forward. We're going to have some forward indications. So all is not clear, shall we say, right? Even though we've seen markets buoyant coming out of these, bear market territory, now we might see that this may be a potential bottom, but I don't think so. I still believe we have to tread water at this moment. Okay, we've got to be mindful of how markets are likely to react to negative earning reports, right? Negative GDP results and a technical recession being confirmed. Now, just to give you a bit of context to that, right? Just to give you some context to that. I've read a report over the weekend. This report is from Goldman Sachs. So Goldman Sachs research team now sees a 30% probability of the US economy entering recession over the next year. That's up from 15% previously. It also implies a 48% cumulative probability in the next 2 years versus 35% previously. Okay, so that's the sort of biggest concern that we have, is this risk of a recession. A technical recession could be confirmed this week, but seeing that actually materialized, where that spiral effect goes down to sort of the consumer sentiment-wise, which we've already seen in some of the US sentiment reports already being at their super low levels. So, that's the way that we're heading. And certainly in the medium to long term, the outlook doesn't look so great, even though the short-term view is that we've seen a potential bottom, we might see a potential rally, but at some point that rally might be faded, okay? So it's clearly been a rough second quarter. Okay? It's clearly been a rough second quarter in the markets, and that quarter is going to end this week. The markets had been due a relief rally for some time. So if we see the sell-off that we've seen so far, so looking at where price action has been, okay, so we can see clearly from 30th May is the highest point that we've achieved since the last month or so, right? So that's the highest point that markets reached 30th May. Going into the 31st, markets started to move lower, and then most of June, right? So early part of June stayed consolidated in this potential sort of symmetrical triangle formation that we've seen here, right? Staying within the price range around the 4,077 up and through to the 4,190 handle. From that point, we've seen from the consolidation phase, price action breaking through, okay? So we've seen price action breaking lower, and that was sort of on the impetus of a higher CPI print, and then that continued with a larger interest rate hike going from a 50 basis point to a 75 basis point being priced into markets, and that is what materialized when Fed made their decision. That brought markets down straight into the bear market territory. Okay, this is sort of the bear market territory here, right? Sort of in this region here. So we're now sort of hovering in this region for some time, mid-June. And you can see sort of the prior few weeks has just stayed within this zone here. So staying below the 3,800 level, okay, 3,800 level being a sort of key resistance here. And then only on Friday, we broke through the 3,800. So we might see price action coming back up to sort of the 4,000 handle potentially, and seeing some rejection if we start to see the turning point in from optimistic to pessimistic when it comes to incoming data and how market participants review that incoming data. So what does that mean? Well, the markets have been due, as you can see, so there's this rally that we've seen. As we've seen this, most of June has been a market sell-off. So as we end the month, we might see sort of markets back sort of test around the 4,000 handle. But the general market sentiment overall, just looking at price action, as you see from those all-time highs, has been bearish. We are in a bear market. Do not forget, we are in a bear market. And this bear market's been the majority of 2020, okay? So those highs achieved were, when's the highest? The highest point achieved was the 4th of Jan. Okay, the 4th of Jan was the highest point that we've seen in price action. Since then, we've been in a downtrend. Bear market. Okay. Only recently, over the last few sessions from last week, we saw some of the yields drop. So we've seen the yields drop on the long-dated yields anyway, drop, come in line a little. But again, that doesn't really matter as much. We're going to see those types of correlations play out when the sentiment goes from risk off to risk on. Many market participants are hoping and calling that we're going to see a top in inflation and in yields. If that's the case, then that means that we've just seen the bottom in equities. But as I mentioned, it's premature to define that. Okay, as you can see, every time there's been a rally in 2022, we've seen that rally being rallied into. Okay, every rally has been sold into. And it's the opposite of what's happened in 2021. So if we look through 2021, starting from this point here, every time the market dipped, it was bought. Dipped, bought. Every dip, markets were bought. Apart from sort of this major correction that we saw, this was sort of the September period. September of 2021, I mean, I can see that there was a larger correction, and that was, in my opinion, largely down to the Federal Reserve also, where a number of Fed members were, profiting on all of their, all the buy signals that they had placed early, sort of when the COVID breakout took place, right? So they're taking a large profit in all those sort of equity markets that they had bought into in sort of early sort of 2020, March, April of 2020. So moving on, let's not go into sort of some of that, what could be defined as insider trading by Fed members. What we might shift onto is going on to maybe looking at some other markets also. We'll have a look at gold, we'll have a look at oil, but I'm not just quite finished on the equity markets. So I might just stick to this view at this current moment. Okay, so as I mentioned, so this move is all the signs of a bear market rally. Okay, so overall bear market, but we're seeing a bullish rally within it, so it's a bear market rally. Yeah. And so probably it shouldn't be confused that we're starting to see a major, we're going to see a major bull trend occurring at this point here, especially for this week ahead. So the week ahead could see a continuation of last week's rally in the short term, some of that relief coming through into the market. But overall, there could be more signs that the bear market is likely to continue. And we may see sell the rally mode coming in at some point this week as well. So just to mention, next week, as we're going into, by the time we complete this week, when we go into the following week, July the 4th is coming around. Okay, so there's a US holiday, right? So there's a US holiday, and it's a long weekend holiday. Now, prior to that long weekend holiday, it's important to know, even JP Morgan has noted this, that portfolio managers will be rebalancing ahead of Q3 and potentially buying more stocks in order to keep their asset mix at the expected levels towards the end of this week. And therefore, do expect volatility. Okay, don't expect, price action to be this small and this continuation mood, there could be a lot of volatility to occur. Okay, and that's why we're now defining a stop losses for the week ahead. What I would look to do is consider the volatility of the market before you apply the type of stop loss that you would look to apply. Yeah. Okay, coming back over to Jerome Powell's testimony last week. Okay, so federal chair, Fed chair Jerome Powell told senators and legislators in his two-day testimony, and this is before Congress, that the US economy is very strong. So it gives a positive sentiment overall. Okay, so the US economy is very strong and could handle much more aggressive moves from the central bank. However, a notably less optimistic economic model maintained by the New York Fed now suggests that the chances of achieving a soft landing could be just 10%. Okay. Now, what does soft landing mean? Well, it means that the Fed are able to give you a forward guidance that doesn't have too much volatility in the equity markets or markets going into a risk-off panic mode, right, without implementing what they're looking to set to implement, right, to tame inflation. Right? And that's seen as a soft landing. We might see equity markets stay around this region or a little bit more bullish, but at the same time, the Fed are implementing the tools that they need to maintain, to tame inflation, shall we say, right? Now, that's seen as a soft landing. And now even the Fed, New York Fed, has mentioned that the chance of that is now 10%, okay? So that can be disregarded. I don't believe that there's going to be a soft landing at all. I think, we're certainly already seeing a hard landing being applied. So hard landing is what we're expecting going forward, okay? And the hard landing pretty much means that every time the Fed states something, we're going to see big moves occurring in the equity markets. And when they are giving us that guidance, we could see panic, we could see risk off, we could see potential recession occurring, okay? And that's what we're potentially forecasting is a hard landing, if most of that's not already been applied, if you look at price action, yeah. Something else to mention, Senator Elizabeth Warren asked Powell if interest rate hikes will bring down gas and grocery prices. Powell replied, "I wouldn't think so, no. If interest rate hikes are unable to bring down inflation, right, then it is likely that the economy will be forced into a recession, right? So we're seeing that, okay, these interest rate hikes, are having a knock-on impact on inflation. We're seeing energy prices, grocery prices, gas prices, and all these sort of prices are being reduced over time. Then we could see, then we can see inflation is being tamed and consumer relief comes into play, right? But it just doesn't seem that's the case. I'm not sure if you guys are. So I know some of you guys are not UK based, some of you are, but if you're UK based, right, we've seen the price of oil come from those 124 highs. At one point, we're close enough to 130, right? Or achieved the 130 handle. Now we're sort of trading around the under the 110 mark. So at one point it was 104. We're trading around 109 now, 109.76. But do you see when you put in petrol into your car that those prices are still elevated at those higher amounts, right? Almost, I think it's £2 a litre for diesel, right? We're potentially sort of hitting that mark. We're at 199, I believe. So even if these energy prices are continuing to be at these elevated levels and then eventually to be tamed and come down to sort of more appropriate levels, more moderate levels, we're not seeing that being applied to consumers at this moment, right? So yes, so just be mindful of that. If actually taming inflation, will that actually have a knock-on impact on the prices that we've seen so far? That may not be the case. Okay, that may not be the case as Powell suggested. So, something else that was mentioned, and this is by Goldman Sachs, we are increasingly concerned that the Fed will feel compelled to respond forcefully to high inflation or high headline inflation and consumer inflation expectations if energy prices rise further, even if activity slows down sharply. Okay, so we're likely to see that the Fed members are going to react to inflation, no matter what the case, and that again points to a hard landing. Going back to sort of other comments from Jerome Powell, he also said, I believe this was on the Wednesday meeting or testimony, the much debated move by the SEC has thrown a potential wrench into common practice for how the US central bank and banking regulators view digital assets held by lenders. So I suspect what we've seen recently taking place with a lot of these stable coins and now some of the CeFi lenders like Celsius, right? We're waiting for more clarity, I believe, in the crypto space, especially from regulators like the SEC. But until then, Fed are unlikely to say much in regards to the crypto space, and that's why we're seeing maybe crypto prices hesitant at this moment, waiting for the SEC to clarify what their regulations are towards custodial providers like Celsius and lenders to bring in more stability in the crypto space. So just be mindful of that. There was also one more point to mention in regards to what led equity markets to continue to move to the upside, right, to last week, towards the end of last week's session. And this came from a Federal Reserve Bank president, James Bullard. He had said that fears about recession are overblown, right? So now you can see there is clearly a discrepancy between how the central bankers view this and how market participants and institutional banks are seeing this. Right? We see market participants and institutional banks their probability of a recession growing over the number of weeks, if not a few months now. Whereas the Fed members are given every indication that that's not likely to take place, and that's overblown. And that's what Fed member Bullard mentioned last week, that recession fears are overblown, and a survey of consumers shows their long-term outlook for inflation has already eased. Okay, so that led to a bit of some of the view that inflation may be beginning to be tamed as the Fed want to tame it. But again, we're still waiting on the Fed. We're still waiting on the print that we're going to see for the week ahead and going into next week as well. Okay, leading into what to expect for the week ahead. Okay, what to expect for the week ahead. We'll bring up the economic calendar. Make sure we're on this week. Okay, so just to mention, it's day 2 of the G7 meeting that began yesterday. So wait for what we hear from these Fed members. Now, the first thing that we're going to hear from them is from a geopolitical standpoint, right? Russia and Ukraine situation, right? So what type of sanctions may they discuss in regards to Russia? What are they thinking about energy prices at where it is at this current moment? So those are some of the elements that we want to hear from this G7 meeting. So we have G7 meeting. Going into the US session, just be mindful of pending home sales. Okay, so some of the gauges that we want to review if there is potentially a recession on the cards is how are houses faring, house prices and house inventory, as well as housing construction, right? How's that faring at this current moment? So do review pending home sales. We do have crude oil inventories to be released at some point. We also have towards the end of the UK session, beginning sort of midway into the US session, with the ECB President Lagarde to speak also. Going into Tuesday, first things first, the BOJ with a core CPI year-on-year figure. Now, we know where the Bank of Japan is at this current moment, right? They're having this issue with the YCC, the yield curve control that they have in place. The yield is going up to the upper limit of that yield curve control. And we've heard that the BOJ may intervene, that they may intervene, but they are certainly viewing their own currency and the weakness in their currency in the yen. So the inflation is what matters now. We know that inflation has just gone past their 2% mandate that most central banks maintain. So it's around, I think it's 2.1 to 2.3% range. And we'll have more information in regards to how have we overshot that previous level. Yeah. And then, of course, the G7 meeting continues going into Tuesday. We have more speeches from Lagarde, we have speeches from MPC member Cunliffe, so just be mindful of that. In the US, we'll have consumer confidence report, consumer confidence survey to be released. Going into Wednesday will be quite an important day, right? So Wednesday's going to be quite a high impactful day, because not only do we have CPI print from some of the Eurobloc region, so Germany and Spain, right? At the same time, we have FOMC members, Mester will be speaking, but most importantly, we'll have the final GDP quarter-over-quarter figure. Yeah, we have the final and the price index also, and then that goes into some important speeches from. We have some of three important central bankers: ECB President Lagarde, Bank of England Governor Bailey, and Fed Chair Powell to speak at 2:30. Yeah, we just confirm where is this taking place. So they are due to participate in a panel discussion titled "Policy Panel" at the ECB Forum on the central bank, banking sort of the conference that's taking place in Portugal this week. Okay, so we'll hear from all three of them at the same time. And of course, we have crude oil inventories. We'll finish off with more speeches from FOMC member Fed Bullard. Now, as I mentioned, right, Bullard previously came out with that hawkish or optimistic view, led to the continuation of that relief rally that we've seen so far in the market. So just be mindful of these speeches. That's how important those speeches are. They can certainly have an impact in the markets that you look to trade. Yeah. As we go into Thursday will be mostly sort of a view on medium to low impact news. We do have some unemployment reports, so just be mindful of that. Okay, so we have, in the UK, we have nationwide HPI, so housing price index. We also have the GDP figure in the UK, current accounts, retail sales in the Eurozone area, German import prices. Going into the French sort of CPI data to be released. And then in the US, we have GDP figure for CAD, for Canada, and in the US we have unemployment claims, personal income, personal spending, as well as core PCE price index as well. And then we finish off the week on the Friday with a continuation of some PMI results. Okay, so we have PMI data, manufacturing across the board. Okay, across the board, global sort of PMI data to be released there. Yeah. Now, this does not also contain sort of some of the earnings on the corporation front. Okay, so when that comes into play, just be mindful of some of the sort of reports and their guidance that they leave us with. So I believe we have Nike on Monday, and that's tracking sort of quarter ended on for May. Other companies also scheduled, such as Jefferies Financial Group, General Mills, Microeconomic, Walgreens, and among some others. Okay, just be mindful of these microeconomic reports that are going to be released that could give us an indication to what the forward guidance is for corporations, right? Are they more pessimistic, or are they able to trade during these these market conditions? Where in the previous earnings season, most of the reports came out mixed. It was a very mixed report, but every time there was a pessimistic report, we did see equity markets sell off, and some of the most important ones that were released in the last earnings season. Yeah. So we're seeing so far, just looking at sort of equity markets, this Monday morning London session sort of already began. It's quite bullish at the moment. So we're seeing FTSE already breaking through those prior highs. We've got a higher low, now potentially making a new higher high. We've seen DAX did make a prior low, but it's not quite reached the previous high yet. The S&P 500 and the Nasdaq continue to be bullish and buoyant there. Gold at those lows, right? So just looking at gold, they continue to sort of it continues to remain at these sort of precious metal lows, shall we say, right? Now we tested a price support around the 1787. Most recently, it got to a low of almost 1800, so around 18, I believe it was around 1805. And now since then, we've potentially put in another new low, so a higher low, around 1816, 1817. But we need a strong break through the 1877 handle. Okay, so we could see markets range for some time here. Now, it's kind of a weird one with gold, right? During the risk off, equity market sold off, you'd naturally see potentially in a risk off, and especially in a panic mode, you would see gold, in risk off mode become buoyant, right? It should fare well. It should have been a bullish move in gold, but no, it did not occur. So we saw risk off in equity markets over the last few weeks, but we've seen the same correlation, positive correlation there with gold as well. So gold also sold off during that period. But then last week, when we saw this relief rally that we're potentially seeing at this moment, this short-term sort of bull rally that we're seeing. At the same time, the correlation is also there positive. Well, I want to say positive. It switched back to inverse, meaning that gold continued to move lower, whereas equity markets rose. So it kind of sort of brings into that view that what are we seeing with gold? What is the actual correlation with gold? So just be mindful of that. Gold hasn't really come into play yet. Okay, gold hasn't really actually come into play yet. Now, what could that mean? Are there central banks out there that are selling into gold? Are there corporations or commercials? If you look at this COT report, the Commitment of Traders report, what are commercials doing, right? What are the producers and commercials doing when it comes to precious metals? It is, in my view, that they are accumulating. They have been accumulating, but prices are still stagnant at this stage. Okay, moving on, let's shift onto looking at the oil markets. We'll look at. Okay, so we've seen a continuation lower in the price of oil and those highs around sort of the early June. Okay, so 8th and 9th of June, we've seen sort of the highs in the price of oil around the 124 handle. There was a retest on the 14th of June, back up to the 124 handle, and then we've seen a continuation lower. Okay, so I might put down to 4 hour time frames so you can see that. Oh, hang on. I've seen some price analysis for some of the guys from last week. Those, okay. So that's what we've seen so far. So that's sort of the test of those 124 handles, and then a nice strong bear trend coming into play, lower lows and lower highs at this moment. Comes to sort of a key trend line in this region over here. So you can see price action, sort of stagnating around this region here and around the price support level. There was a bit of an overlap. Just be mindful that tends to happen. There's a false breakthrough. It didn't materialize. There wasn't a continuation of rapid selling or selling pressure coming into this. So the aggressivity that you expect from selling pressure didn't materialize, and then the market became more of a to the bid, right? And you can see sort of price moving sideways and then breaking, sort of coming out to test those highs again, and then we're continuing to the upside in this case here. Now, what's being reflected here? Now, the biggest scenario, especially from sort of the selling pressure that we've seen, is that as we've seen the rise of recession grow, then we're seeing that that's having a negative impact in the price of oil. And that's the correlation that we're seeing there, okay? So the continuation of recession and the fears of recession and the probability of that occurring is certainly going to be a negative for the price of oil. But if we see, for example, Shanghai come out of these restrictions and declaring victory over COVID, that's going to be quite positive for the price of oil. So those are the two areas that you need to review when it comes to the price of oil. Now, switching over, let's have a quick look at some of the FX markets. Dollar index, dollar back at those lows again, testing and through the 104 handle. It's stagnant, moving sideways at this current moment. So it's reached those highs, those all-time highs around the 105, or not, what is it, all-time highs? Year-to-date highs, shall we say. Okay, year-to-date highs, we've sort of been tested around the 105 handle. So was surpassed actually. We were close enough to, 105. Let's bring that a little bit lower. Yeah, so 105.75 handle. From that point, we reached a low around the 103, 103.50 handle. And since then, we're trading sideways. We're starting to sort of come back and test this price support region here. So at the moment, dollar index is not faring so well, and that's largely due to the inverse correlation that we're seeing with obviously the equity market. So equity markets continue to sort of have this relief rally. We may see dollar correct at some point, but overall the trend has been bullish year to date in the dollar index. The VIX, look at the VIX. VIX is back below the 30 range. Okay, so it's since I believe the 13th of the 10th. You said between the 10th and the 13th of June, it's been at these elevated levels above the 30 handle. It's now back below the 30 region, around the 28 mark at this current moment. Now, when it comes to sort of euro dollar and cable, okay, so we're not looking at the dollar reasons behind this. We're looking at more the euro and sterling. Now, euro and sterling is likely to fare well. If we see this buoyant rally coming into place at the beginning of this week, that's going to have a negative impact in the price of the dollar. We might see now some euro strength and some sterling strength come through. Yeah. Now, we do know what's to be expected when it comes to rate rises. We know that, for example, that there's another 75 basis point rate rise expected from the Fed, right? And that can continue to year end, where we might see 75 and 50 basis points thereafter to come in line with what their forecasted projections have been on the dot plots. At the same time, we know that the Bank of England have raised rates, and they were the first major global economy, major sort of, G7 country go on to raise rates for the first time, and that took place in 2021, end of 2021. There was some views that they should have raised rates in October-November period, but they did not. They raised rates in December for the first time, and since then they've had 5 consecutive rate rises of 25 basis points. And that's them raising rates, but gradually on an incremental level, not being extremely hawkish in the way of the Federal Reserve. But if you look at the equity markets, the UK equity markets, the FTSE 100, is faring much better than the US equity market is, because of these gradual steps that they've taken place, right? Yes, we've seen a lot of sterling weakness come into play, because one of the key elements that have come through from the last few meetings is the Bank of England doing enough, right? Are they raising rates enough to counter inflation? If you're going to tame inflation, do it properly, right? That's what the views are. If you're going to try to tame inflation, you give us guidance that you want to tame inflation, then do it justice. Make sure you raise rates to a point where it is being reduced, right? That's what the markets is screaming at them about. But they just do these gradual 25 basis point rate rises. And what we're expecting, we're over 9% in regards to inflation in the UK. And that's likely to be double digits very soon. The Bank of England have forecasted a rate inflation of 11%, right? So yeah, there is a couple of elements to what's also keeping the sterling weakness there. One is, of course, is the Bank of England doing enough in regards to taming inflation. And now that they've already given us an anticipation of a 11% inflation to be expected, and we're seeing these energy prices at these elevated levels, it's giving us, give me a second, guys. It's giving markets the view that there is a potential higher risk of a recession in the UK than there is in the US. So there has been some government stimulus that's been offered, right? There has been some government sort of stimulus that's been offered. But again, if we go back to their annual budget, where they raised the national insurance of 1.5%, right? That's also going to be priced in. Each person in the UK, that pays tax in the UK, will have to pay 1.5% more in their national insurance, that their contributions that they make, right? That's certainly going to have an impact. And yeah, so even though that we've seen, this 15 billion pound stimulus by the government in regards to these energy, electric and sort of gas and sort of petrol being at these elevated levels, these coming into play, is that enough? I don't think so, right? In regards to the euro block, I'm looking at the euro dollar. We've seen some, bullish moves there in the euro. Now, there is a credit spread risk, a credit debt crisis risk in the eurozone, like it had been in between sort of 2010 to 2015, where we saw all the sort of debacle that had taken place between Greece and Italy in the eurozone. So the southern region of the euro in the euro bloc, countries like Spain, Italy, have a much greater debt to GDP ratio, which means that their yields are substantially higher because of the risk of default than it is for a country like Germany within the euro bloc. So, what the ECB want to do is not have a debt crisis like they've seen happen in sort of the 2010s and between 2010 and 2015 range, right? What they're looking to do is implement a new tool, and they haven't given us a strong indication of what this tool is going to be doing, but there is some indication that some of the yields that some of the bonds that they've been buying, the maturities of those bonds, some of that coupons will be put back into the system again, something of that another. It's called the, should we say, anti-fragmentation tool that they're looking to apply. We'll hear more information around that. But putting that aside, that potential risk aside, a key element will be is you have to be mindful of the rate guidance that the central banks are giving us. And most importantly, Christine Lagarde went from a dove to a very strong hawk now. And we're expecting a strong rate rise very soon, right, in July, right? So, and that's some of that will be priced into it as we come closer to the time. And especially this week, we've got we've got ECB president to sort of come out with a couple of speeches this week and give us an indication of what she feels is likely to come into play in the upcoming few weeks leading into the ECB meeting. And as I mentioned, we have inflation report from the Bank of Japan. That's one to also watch, especially that we're testing that upper yields of barrier for their YCC and the inflation now just passing the 2% mandate. What will the Bank of Japan do? Yeah. Now moving back over to digital assets, right? So focusing on digital assets now, the two that I want to focus on from a holistic crypto focus view is Ethereum and BTC USD. Now, both are still at these lows, right? Both are sort of, testing these lows that last week and the prior week, we'd seen a lot of selling pressure coming into the crypto space. And that followed first, we had this Terra Luna situation that occurred with this stable coin, unpegged. The stable coin got unpegged, a lot of selling pressure came into it, and completely obliterated the stablecoin and decimated sort of the reputation that stablecoin had. Then we'd seen some of these hedge funds, not going to name names, but some of these crypto hedge funds also go into potentially administration by being overly leveraged in some of their positions and not seeing potentially sort of, a bear market or a substantial sell-off that we've seen. And that led sort of these prices from sort of the 30K range go through down to these 20K range. And then most recently, we had, of course, Celsius, and there was highlights from Binance also in regards to not allowing for withdrawals, right? Halting withdrawals, especially Celsius, right? So these CeFi, these lenders, there is question in regards to how can you offer 18% yield, and that was something that Celsius was offering at the time. But okay, and that's just brought in more risk into the space. So what we're seeing is that the way to view it is we've got two outcomes that have occurred, right? These are idiosyncratic outcomes, right? The Terra Luna stablecoin, the Celsius, some of these hedge funds, but they've all come like buses. When you're expecting that one bus and doesn't come for a while, then you have three buses in a row. That's what we've got in this crypto space at this moment, is a number of pessimistic news coming back to back in a very short period of time, leading there to be a continuation in this sell-off. Now, in the long term, the overall market is still buoyant, it's still very bullish. If you look at sort of where we are in regards to, from the 2020 price levels to where we are now, we're still in positive territory, right? And it was one of these back tests that Michael Saylor spoke about in regards to that. If you want to be, no matter what, in the profit in Bitcoin, right, you've got to hold it for a minimum of 4 years. Okay, that's the kind of holding period that you need to have. If it's less than 4 years, then you can expect your holdings to be in the negative at some point if you can continue to accumulate and bought within that 4-year period. So expect there to be some downside in crypto space, and price actually moving sideways at this current moment. There could be a continuation if we hear more rhetoric, more news come into play. But if we see equity markets continue to rally, we could also see crypto space recover some of those losses that we've seen most recently. Yeah, and that goes for Ethereum as well. Okay, so just crypto space as a whole being significantly impacted due to some of this news that we've heard most recently. Okay, and I believe that sort of covers all the key points that I wanted to mention at this point over here. Now, as I suggested, as we're going into the end of the month, okay, as we go through to the end of the month, you need to be mindful of how the markets are going to react, okay? And one thing's for sure is that there's going to be some volatility to expect as we end Q2, okay? There's certainly going to be banks out there that are going to adjust their portfolios accordingly and de-risk in some case. So be mindful of the positions that you take, have wider stop losses if you can afford to do so. So, go for higher probability setups. Don't just be bullish now. Don't think that this is the bottom in play. Listen to incoming information. There's a lot of speeches to be expected. We could see markets fade the most recent rally we've seen. But hey, we could sort of go on to close this week in the bullish side, as we've seen overall most of the month has been negative anyway. So there could be some recovery to close the month at a balanced level, right? So just be mindful of the close of the month and the close of the quarter, going into a new month and a new quarter. Earnings season to be expected. We've got a lot of new inflation reports. We've got, most importantly, anticipated will be GDP and whether we are in a technical recession. That's something to look out for also. Other than that, hopefully you've enjoyed this weekly market brief. If you have any questions, please feel free to send me a DM and I can get back in touch with you there. Enjoy the rest of your week. Take care. Bye-bye.